Today we're looking at what's called property share. So if you have a mate or you have someone that isn't related to you and you're looking to buy a property together, this is a video for you. We're going to look at what property share is and, more importantly, how it's going to save you from having a joint commitment so that if your partner in crime does default, it's not going to affect your credit file. So let's jump in. So starting off with what most people will do when they're buying a property. So say you're buying a property with a mate. Ordinarily, people will get a loan together and purchase the property together, owning it 50-50. And this is how it generally will look. So if we take a look, we will have, let's call it John and Jim. Nice and easy. John and Jim. And what they'll do is that they will apply to the bank. So this is a bank here. They'll apply to the bank together for a loan. When they apply to the bank for a loan, they will look to both put in a deposit and will both take out a loan. So let's say that they take a $400,000 loan out. Together, combined, they'll say, hey, look, we own that $400,000 loan. We own $200,000 each. And we're going to pay our fair share, whether it's both $1,000 a month, whatever that might be. We're going to pay our fair share consistently. So in the background, John and Jim have an agreement to say this is what we're going to pay each, and we're each going to make sure we look after our side of the deal and pay it off. Now, John and Jim think that if either don't pay, that then the bank will honor their agreement. You could think of it like a handshake agreement that they've said this is the way it's going to be, but nothing is legally binding. So the problem with this is it's called a jointly and severally liable loan. It essentially means that if John can't pay the mortgage, that the bank will be going after Jim, even though Jim is making his payment towards his commitment, the $1,000 a month. And even though it's only John that's not meeting his commitment, Jim will be up the creek with John, with the bank looking to repossess, potentially, worst case scenario, repossess the property. Now let's look at the worst case scenario. So if that were to happen, not only would John's credit file have a default listed against it, but also Jim, even though in this case, Jim had done nothing wrong, had paid his mortgage on time every time. Now, you can look at this same way, and this does happen with couples also. Unfortunately, in divorce proceedings, some couples, one side will actually stop paying the mortgage, and that also can have an effect. So property share gets around this whole scenario. Property share is much the same as a guarantor home loan, but works a little bit differently. So guarantor home loan, just for those that aren't aware, how it works is that, let's say we've got mum and dad's property over here, and you've got a property that you're looking to buy for $500,000. Typically, you'll borrow 80% on your mortgage, and then the 20% will be secured against your mum and dad's mortgage. This allows you to borrow 100%, meaning that you don't need a deposit, and it allows mum and dad to not own this debt of $100,000, but to allow it to be parked on their property so that you don't need to come up with a deposit. The bank is happy with this because all they are concerned about are the security lending margins, also known as loan to value ratio. So long as it's under that 80% mark, everyone's happy. Now, property share is much the same. So if we go back to John and Jim, going back to that $500,000 property, so they're looking to buy $500,000 and they only need a $400,000 loan. So what a property share scenario, or what property share is that the property is put into two different camps. In Jim's camp, he will have a $200,000 loan, but in the background, we know this property is owned by John and Jim. So the title is owned by John and Jim, and that means because Jim is looking to take a loan out of $200,000 here, that John will have to become Jim's guarantor. In this way, Jim owns this full debt. So this $200,000 is purely Jim's, but the guarantor in this scenario doesn't own that debt. Like a guarantor home loan, he does not own that $200,000, which means that if Jim were to default, so long as John on his side is paying his mortgage on time, will not be affected. So let's unpack this a little bit more. So we go over to John's side and we'll do the same. So the same property, he'll have a $200,000 debt on it. We have John and Jim. So Jim will be the guarantor. We'll put a GT. Over here we'll have, so I'll remove Jim from here. So John will be the guarantor, GT. And the debt is owned by John. So what we can see here is that high level, it looks complicated, but in the details, it's very simple. They will be borrowing $400,000 and it's split down the middle. That John will own a portion of that debt, $200,000, and Jim will own the other portion of that debt, $200,000. That in both cases, John owns his debt of $200,000 and Jim owns his debt of $200,000 likewise. That if worst case scenario, if John were not to pay his mortgage over here, that nothing's going to happen to Jim's credit file. Now, what can happen though is that the repossession can still take place by the bank to recoup the costs on John's behalf. But more importantly, it'll mean that Jim won't be penalized, because if you get a default on your credit file, it might mean that you're not able to borrow for up to 7 years. So a property share arrangement is really beneficial for many different scenarios. If you're in a new relationship and you're not too sure where it's going to go, great idea here, because again, a lot of things we've seen in the past is a breakdown when, particularly in court proceedings, when one party stops paying the mortgage and the other one continues, it does impact that person. Even though they're paying on time every time and they can prove it, it still will go on their credit file as a default because of the way and the nature of the jointly and severally liable loans are structured. A property share arrangement will get around that, because essentially it's only your debt you need to worry about. If your partner isn't paying their debt on time, that yes, it may impact you in way of having to sell the property, but in way of your credit file, it's purely safe. If you're looking to buy with a mate or a friend, this is another great structure or strategy. You're looking to buy with family members, another great way, another great thing to look at. So that's what property share is. If you're looking for advice on whether property share is for you, then reach out. Here at Hunter Galloway, we get home loans approved. So if you live in Australia and looking for a great mortgage broker, we can help. Visit us online at huntergalloway.com.au or call us on 1300 088 065. There's no fee for our service and we help Australia-wide. So thanks for watching, and until next time, I'll catch you then.